Welcome to Yahoo Finance's special coverage of the June CPI report. I'm Julie Hyman. The key inflation number just crossing the wire and coming in somewhat in line with estimates. 0.3%, a month-over-month increase in the consumer price index. If you take out food and energy, the increase was actually smaller than estimated, 0.2% versus the 0.3 that was estimated. And then as we take a look at the year-over-year numbers, consumer inflation rising 2.7% year-over-year. If you take out food and energy, you get a 2.9% increase. Now, even though that core inflation month-over-month number was a little bit milder, a little bit more benign than estimated, it still represents an acceleration from what we saw the prior month here in the month of May, where we saw headline and core inflation ticking up just 0.1%. So inflation heating up just a little bit here, but still coming in core a little bit milder than estimated. It is interesting, the year-over-year numbers not showing any kind of being more mild than had been estimated here. So this is the fifth straight month that we have seen that core print has come in a little bit lower than had been estimated. What's interesting here, of course, are the implications. The implications of what this is showing in terms of tariffs, because there's been a lot of attention, a lot of questions about why we are not seeing more of the increase in tariffs feed through to some of these numbers. There are implications, of course, as a result for the Federal Reserve as well, and whether they are going to cut rates at a time where they are under enormous pressure from the White House and President Donald Trump, who has been very vocal about his desire to have them cut rates. So a lot of different implications, a lot of reasons to be paying attention to this number here today. If you look at it, take a quick check on what is happening in the futures as a result of all of this, we are not seeing much movement, a little bit of a tick down in futures from where they were before this report came out. We're going to be keeping an eye on other assets as well, but typically it takes a little bit of time for people to go through the data and to make sense of it. So, Greg, a moment ago, I was talking about the sort of feed through from tariffs here. Once again, we're looking at a core number of 0.2% that is less than the average economist estimate. What's your first reaction here to this number?
Well, I think you're absolutely right. We were anticipating that about a third of the monthly increase in CPI would be driven by the tariff increases. It seems to be, from this initial read, that it's a little bit less than a third. But still, you're starting to see some of the pressures emerge in some of the categories that were first exposed to the tariff. This month, you saw a rise in apparel prices. You're also seeing higher furniture and furnishings prices. You're seeing higher recreational goods prices. So there is a little bit of an initial influence from the tariff. But we have to keep in mind that businesses have been using a wide array of strategies, from inventory management to sourcing from different places, to spreading the cost increases across different goods, as well as using their margins to buffer some of the shock as an initial mechanism to avoid passing on the cost to consumers that are, as we remember, very sensitive to these higher prices. So this is just the initial onset of these tariff increases, and we're going to see more over the course of the summer. I expect a fairly muggy summer when it comes to inflation.
Claudia, what about you? Are you kind of seeing the landscape and the feed through from tariffs in a similar way?
Right, I agree. This is an adjustment process to a massive cost shock that businesses are facing. And so, we learn from the data how this is feeding through. And I think it's going to take some more time for us to, get a sense of the full effect of these tariffs. And, remember that we aren't done in terms necessarily with the price increases through tariffs, because the tariffs aren't set fully. So I think this is something to watch in the data, but I agree with Greg. You can see in this month ever more, an impact from this on prices. The, core goods did move up their month over month inflation in June.
And Greg, I guess the thing that I continue to struggle with, and I know this is something you guys are thinking about, the Fed is certainly thinking about it, is why and how, when we do start to see the tariff effect, why it would last longer. In other words, the Fed's trying to figure out, when is the increase in tariffs going to make its way through to these prices, A, and B, will it be a lasting effect? Will it be, going to use the word transitory, or will it be lasting? Why wouldn't it just be, that one-time adjustment? What would cause it to last longer?
So I think two things are important here. One is the effective tax rate, the effective tariff rate. When you look at collected custom duties, you see that in the month of June, the effective tariff rate was only 10%, when the average tariff rate was around 15%. So the tariff bite has yet to fully materialize. The second thing is whether this is more of a one-time shock or a persistent inflation shock. I would tend to believe, based on a number of surveys and a number of conversations we're having with business leaders across a wide array of sectors, that this is going to be more of a one-time shock. That does not mean it happens overnight. It means it happens over the course of a year, but it's still rather transitory. And the reason why we believe that's the case is because a lot of businesses are talking about rapidly passing on the higher tariff shock from these higher duties. So we're anticipating a rather swift pass-through. But if we are in an environment where there are staggered tariffs over the next year, then there is a risk of more inflation persistence. And I think that's the key risk for the U.S. economy right now.
And of course, we don't even know what the tariffs are going to be next month, let alone if they're going to be staggered. So, Claudia, let's bring it to the Fed. I mean, they've got a tough decision once again ahead of them. What are the risks of them continuing to wait?
Well, the federal funds rate is what the Fed characterizes as moderately restrictive, right? So it is putting downward pressure on the economy, on demand. I mean, that's the tool the Fed has to bring inflation down. And I think to add to what Greg said, it's really important to set this in context. The inflation in the United States has been above the Fed's target since 2021. It is still elevated, and particularly services inflation remains quite elevated. The Fed is committed to getting inflation back to its 2% target. And I think a risk with tariffs, which might not normally apply, but a risk here is that because we've been at inflation at an elevated pace for so much time, that people are just going to build that into their thinking. Right? Are they going to think, hey, we're going to get 2% inflation going forward? Or maybe they'll get stuck at this around the 3% level. And that's a big risk to the Fed. And that's the only reason that it is keeping interest rates in a restrictive place, because it wants to get inflation back down to target. And I think, we have seen some progress this year in terms of inflation. I think it's really important to look at these core services. We have made some progress, but they need more reassurance that we're on the path to 2% and that these tariffs are not going to throw us off and really get stuck above target.
And Claudia, when we talk about tariffs, we're mostly talking about goods pricing. But of course, services pricing is the thing that, until we got into this whole tariffs discussion, was the thing that was stubbornly not coming down. Are we seeing any progress on that front?
Right. Well, in recent months, we did see some notable progress. And I think you saw travel inflation, recreation being really soft, things where you'd think, oh, maybe this is like there's kind of a softening of demand, which again would be an environment where maybe tariffs wouldn't have that spark to inflation. And we have seen a real kick to some of the rent, owner's equivalent rent slowing down, which had been waited for a long time. I think we saw a little bit of give back in today's data. Things are noisy. We're not going to, be on a glide path. But like the Fed, tariffs are a risk. Normally you would, quote unquote, look through them. The Fed would ignore them because they're a one-time adjustment. But it's really important, if the Fed looks through the rest of inflation, which is largely these core services, have to give them encouragement that we have the momentum to 2%. I think they're building that case, but I don't think it's a slam dunk yet, and particularly because the economy, the labor market seems to be holding up relatively well. They've got a little more time to do their fact finding and bring the data in.
And Greg, I want to ask you about the Federal Reserve as well and its reaction to all of this, especially in an environment where, I don't know if we've had a post on Truth Social yet, but I'm sure it's only a matter of time before the president reiterates his call for rates to be cut. And this, of course, as we know, that the White House is looking for the next Fed chief. So amidst all that pressure, what do you think the Fed does?
Well, I think generally speaking, I agree with what Claudia was mentioning in terms of the disinflation on the services front. I'm a little bit more optimistic because I've seen some very encouraging news in terms of what we're seeing on the shelter cost disinflation front, also the auto insurance disinflation front. And if you look at some of the details in today's data, you'll see that hotel prices are falling. You'll see that airfares are also falling. So you're seeing signs of consumers being more cautious with their outlays, which is generally disinflationary. So we have these two currents. On the one side, disinflation that continues and has been occurring over the past 18 months. And on the other, the onset of the inflationary push from tariffs As we know, the Fed is quite divided. There are 7 policymakers that would favor no rate cuts over the course of 2025. There are 8 that would favor 2 rate cuts and a couple that would favor 1 rate cut. So there is a big split within FOMC policymakers. I would tend to believe that there is room to be easing, but as policymakers, those that favor rate cuts will want to see more evidence of an economic slowdown in the data before they proceed with such easing. That's not yet evident, and I think the Fed will wait until the later part of the fall before it proceeds with the onset of any rate cuts.
Greg and Claudia, great to see you. Thank you so much.
Thank you.
Great, thank you.
For the month of May, we did see apparel prices and car prices fall, and that kept inflation relatively tame. We did see some signs of tariff pass through for the month of June, although not at an alarming rate. We still have inflation that's relatively subdued at that neutral level. But let's talk about some of the price increases that we did see. I mentioned apparel prices. That index increased 0.4% last month. Footwear also saw a 0.7% increase after multiple months of declines. Furniture and bedding, that rose 0.4% after a 0.8% decrease in May. So a potential sign there that tariffs are beginning to work their way through the system. Beef prices stood out to me, pretty significant jump there of a 2% increase. However, egg prices, that decreased 7.4% month over month. This has been a very volatile category, one that we've been watching closely as a gauge when it comes to just how much pressure the consumer is facing at the grocery store. And to that point, the index for food increased 0.3%. Food at home rose by that same level, while the index for food away from home rose 0.4%. Now, that was an acceleration from May. So food prices continue to remain sticky. We're just unable to budge from some of these higher levels. But there were a few positive signs. New vehicles, that dropped by 0.3%. Used cars and trucks dropped by 0.7%. These were categories that we've been expecting to see price increases due to these tariffs, but we just haven't seen that materialize. Shelter also moderated month over month, increasing 0.2% compared to May's 0.3% rise. Shelter has been a very sticky category, a big elephant in the room when it comes to the Fed, so positive to see that moderating a bit. And then the energy index, that did rise 0.9% in June as the gas index increased 1% over the month. That contributed to some of the firmness that we saw in that headline inflation, likely due to the spike in oil prices that we saw a few weeks ago amid those Middle East tensions. Heading into this report, we had seen gas prices steadily falling, and they have since returned to those lower price levels. I'm looking at crude oil right now, hovering below $70 a barrel here. So largely neutral inflation report coming in mostly in line with expectations, and we're not seeing a significant impact of those tariff increases just yet.